This is the Equity Management Academy Weekend Podcast for October 22nd, 2021. Gold. The seasonal lows appear to be in place. Summary. It has been difficult to trade the metals markets over the past year. The fundamentals have been indicating that gold and silver should be shooting up. The debt ceiling will have to be increased or the world economy will collapse. The high debt levels and massive stimulus are destroying the value of the dollar, which should cause precious metals to soar, but they haven't yet so far. In the long run, we believe they will. Fundamentals. It has been difficult to trade the metals markets over the past year. The fundamentals have been indicating that gold and silver should be shooting up, yet the markets have been going up and down a great deal. Emotions drive the markets to extremes, which we use the AI to monitor and determine when the market hits those extremes and it is most likely to revert back to the mean. The debt ceiling will have to be increased or the world economy will collapse. They also cannot increase interest rates or defaults will ripple through the global economy like a tsunami. A rise in interest rates will also cause a massive correction in the equity markets, which the Fed is unlikely to risk occurring. The high debt level and massive stimulus are destroying the value of the dollar, which should cause precious metals to soar, but they haven't yet. In the long run, we believe they will. Mermican Research published a key report on gold on October 15, 2021. The report argued that the Fed's printing of money should have caused precious metals to rise in price. They have not, but that may be about to change. One key is the Fed does not really print money. They create bank reserves. Banks use the reserves to lend against assets, which then increase in value, increasing the price of a financial asset while holding its cash flow constant means that discount rates fall. If discount rates fall, then construction is favored, such as it happened in China, in Manhattan. However, the building leads to overcapacity, which then reduces cash flows, lowering consumer prices and causing defaults for banks, unless central banks back them up by providing new reserves. Over time, if the cycle of bailout continues, more and more of a society's capital gets invested in poor investments. They become like ancient pyramids, a lot of economic activity but with little result and nothing produced in the long run. The COVID pandemic led the Fed and government to decide that no one should suffer too much from the pandemic economically. The Treasury paid those who could not work and helped businesses that were hit by the pandemic. Therefore, the Treasury directly contributed to consumer inflation. Since income and spending stayed the same in the face of falling supply due to the lockdown and supply chain issues, then prices had to rise. Since the pandemic began, the Fed's balance sheet has more than doubled, triggering inflation in recent past technological innovations. China's growing workforce, underpriced investment capital, and the CPI being reconfigured to underreport inflation given decreases in quality all helped keep consumer inflation in check. Those four factors are no longer doing so. Technological innovations are now focused on entertainment, efficiency, and financial speculation. China is facing a decrease in the number of workers due to the results of their one-child policy. Energy prices are surging, which suggests that inflation will not be temporary. There has been massive underinvestment in oil, natural gas, coal, and nuclear, which are traditionally the most productive parts of the energy sector. Natural gas prices are rising, as are oil prices. In fact, inflation is hitting almost every commodity from copper to oats, cotton, and soybeans. Everything is up double-digit percentages inflation. When we have inflation, we also see high volatility, just as we are seeing today. The 1970s also saw major volatility in oil and other commodities. With commodity prices and labor prices rising, consumer prices must follow. The CPI assumes that if filet mignon becomes too expensive, they will shift to buying chuck steak. The price of steak remains the same, but the quality falls. That shift in buying to lower quality products hides inflation for a time. But if inflation hits double digits, then that hidden becomes apparent to everyone. If inflation hits double digits, the Feds may view it as a means of decreasing debt burdens. If inflation doubles the price of everything, then debt levels are halved in a way. The problem is that inflation is not even in some sectors, and goods will rise for far higher than others. Inflation will also lead to more calls for government aid to certain groups. Such a situation would be great for gold miners. However, commodity prices rise in terms of gold when credit increases, which suppresses gold mining margins. The reverse is also true. Therefore, gold mining is a bad business during periods of credit growth and a great business during credit crashes. The Fed is unlikely to recognize this inflationary cycle, since the Fed appears to see the price increases as caused by supply chain issues, not other causes, such as the easy money policy of the government. As the report concludes, the surge of prices everywhere will either force yields higher or induce accelerating QE. The former would swiftly lead to a debt crisis and perhaps sovereign credit crisis. The latter destroys the currency. From 1971 to 1974, the gold price shot up 5 times. From 1978 to 1980, gold rose 5 times. We are headed into similar times. Buy gold. Gold, mean reversion trading instructions. Our reports help you navigate the treacherous waters of the metals markets. Our annual gold report, based on our variable changing price momentum indicator VCPMI, for example, published in September, argued that the annual trend momentum of 1794 was bearish. The price momentum for gold of 1840 was bearish. In short, on an annual basis, you should take profits at 1572 and 1409. If long, for the year from September to September, you should take profits at 2003 and 2271. The exit levels for the shorts are also excellent levels at which to enter the market and go long, while the levels to exit longs and great levels at which to enter the gold market and go short. We have been trading gold above the monthly average price of 1772, which we did aggressively on October 13. Then the price momentum turned bullish. Although we have some pullbacks on the short term, the bigger trend is bullish. We are seeing a lot of buyers come into the market. The monthly sell one level is 1823, which is the monthly target. Right now, it is 1840, which is the 360-day moving average. Even though the 360-day moving average is in a bearish price momentum, we are beginning to see the momentum of the market based on the weekly and daily data give us an indication that the price momentum is turning bullish. A close above 1785 will negate the bearishness. The bottom in gold came in on the 29th. Since then, we have been moving up from 1721. The market is in a nice uptrend. This is the area where you want to accumulate. The Equity Management Academy, Patrick MontesDeOca said. Gold traded above the daily level of support at 1780. We are also above the weekly average price of 1783. Above that, the sell one level of 1793 and the daily at 1802. The market, by trading above the daily and weekly average, is in a bullish price momentum with a bigger annual bearish trend. The seasonal lows appear to be in place. MontesDeOca said, we want to see the market test levels of 1793 to 1797 and 1802, all the way up to the weekly of 1825, which is the target for the rest of this week.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Patrick MontesDeOca with a live trading room from the Equity Management Academy. I want to welcome those new subscribers that have joined us, basically you have the opportunity to see how I am using this fundamental information. The report that we just saw here was published in the Associated Press in Seeking Alpha in the premium service, which is free for all those people that want to read some of the reports that we published. And we share a lot of great information for you self-directed individuals that want to make a difference in your bottom line. What I would like to do here is get back into the market here and see what the report, the data for this week is telling us. So if you bear with me here, let me look at the chart here. Pretty much we've completed the target of 1811, which is the first sell one target. This information was published on Saturday to all of our subscribers, and I'm sharing this information for the benefit of those individuals that are self-directed traders that want to have what I believe is a quality service that gives you a metric tool that essentially is called mean reversion trading. It's using the reversion to the mean principle. And so let's take a listen to it, and we'll come back and analyze it.
Hello everyone, this is Equity Management Academy with the weekly gold report for October 22nd, 2021. Summary: the weekly trend momentum of 1781 is bullish. The weekly DC PMI 1790 is bullish price momentum.
The weekly data is on the right of the chart. On the left is the daily data.
Take profits 1819 to 1945. Trading instructions. Weekly trend momentum 1781 bullish. The gold futures contract closed at 1794. The market closing above the 9-day SMA 1781 is confirmation that the weekly trend momentum is bullish. A close below the 9 SMA would negate the weekly bullish short-term trend neutral. Strategy: we are coming in with a weekly bullish sentiment unless it closes above 1781. Weekly price momentum 1790 bullish. With the market closing above the DC weekly price momentum indicator at 1790 is confirmation that the price momentum is bullish. A close below the DC weekly, it would trigger weekly stops and negate the bullish trend neutral. Strategy: we are coming in this week with a bullish price momentum unless it closes above 1790. Weekly price indicator Exit longs. Sell 1, 1845. Sell 2, 1819. Exit shorts. Buy 1, 1764. Buy 2, 1734. Look to take profits on shorts and corrections at the buy 1 and 2 levels of 1764 to 1734 and go long on a weekly reversal stop. If long, use the 1734 level as a stop close only and good till cancel the order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1845 to 1819 during the week. Strategy. Bearish targets are 1764 to 1734 to cover shorts. And look for support. Look for reversions from here to unfold back to the mean. A close above 1790 activates the 1845 to 1819 levels of resistance and targets.
I wanted to take a look at the weekly data here in gold, and you can see the AI gave us pretty accurate information in terms of what to expect as we come into next week. So what you do here is if you came in long in the futures contract, this is the first level where you want to lock in some profits. The targets have been completed. This is the first level of resistance, as most technical analysts describe this. And the pivot points for us, by incorporating the AI, it activates the pivot points to a probability model that identifies for us that the market has targets of 1811 daily to 1829 on the daily. The weekly data has targets of 1819. $18.19 to $18.45. Now, the one thing that it's important to understand about the metrics, the VCPMI, is that this gives you a multidimensional look at the resistance support levels in the market than the one-dimensional view that you get by using simply linear or one-dimensional information. These are pivot points. They have a very specific structure that do not use more than 5 pivot points, and within those 5 pivot points we extract the average price, daily, weekly, monthly, yearly, cyclically, and within that structure we identify the probability models that begin to tell us where we can expect the extreme levels of the supply and demand to come into the market. The function of the market, if you really think about it, is exchanging the supply and demand, which is based upon your belief that the price is going to go up or the price is going to go down. And what this metrics does for us is it identifies the extreme levels of that speculation. And so it tells us that we are approaching 1811, which is the first daily level that recommends for you to take some profits, book some profits. If you are a multi-trader, multi-dimensional trader, multiple positions, then this is where you can begin to unload some of your profits if you come in with multiple positions. I'm not here to show you how great I am as a trader, but more or less to teach you how I'm using this information in the exact same way. And I have recommended to my traders in the live Discord trading room that this is the level where you want to lock in some profits. We have this information prospectively. We know ahead of time that the area in red is what it's called distribution of supply. And in order for the market or the price to validate the momentum of the price, whether it's considered undervalued, valued, or overpriced. The market price, the market itself would need to digest this resistance level in the very same way that we've seen the market buyers start coming in and buying the market from the levels that we saw all the way down to that 1763 area. The 1721 area is the measurement bottom that we're using for the for this next fractal in price, because this was the expected seasonal low that we published way ahead of time, that on the 28th of September, we begin the next seasonal cycle. The next calendar year begins for us on September 28, 2021 and September 28, 2022. And what we see here is basically the price bottoming on the 29th of September. That's pretty good estimation and forecast, you might say, in terms of a major bottom in the market developing. Now, this gives you, once you feel the confidence and see that, first of all, this is not a perfect science, that it does give you a higher level of probability models for you to execute. And in this case, it turned out to be 100% correct. Not only did we expect a seasonal bottom to come in here, and we published a report in Seeking Alpha and the Associated Press, but we came into a level that is in blue. And when the market comes down to the levels of blue, it basically begins to tell you that this is the area, what it's called accumulation of supply. This is the area where you want to see buyers come into the market, accumulating supply. And that's exactly what we are seeing here, that these levels provided an extreme value, oversold conditions, and what we consider the extreme below the mean. In terms of probability models, the buy to level, whether it's daily, weekly, or monthly, it gives you a 95% probability factor. That's not a guarantee, but a probability factor that if the price comes down here, unless negated, which then the program will go neutral, which is by closing below and following through to the opposite direction, that will be basically beginning to initiate a different price fractal. So what the algorithm does is it gives you the extreme levels of speculation where you can expect buyers to take profits or sellers to take profits. If you're trading the market using mean reversal trading, that's exactly the levels that as a professional trader you want to execute your trades. And what this does for me is it pretty much gives me a real strong model that essentially begins to confirm or negate where the market wants to go. And it's prospectively. So what I have here basically, as you can see, these lines are a combination of different indicators here. We have Fibonacci trend fan lines, we have Fibonacci retracements, and we have pretty much the Fibonacci structure of the program within this larger frame, and we include the variable change in price momentum indicator, which is our probability models that you can see here have activated a pretty accurate trend direction in the market. And we are at the sell one level daily, which represents that we are approaching about a 90% probability of resistance at that point. And depending upon the market action, whether we have more buyers that come into the market than sellers that essentially will take the supply that's being offered here, then we begin to see that underneath the market, we are seeing buying with strong hands, particularly if it's supported by volume or open interest. So we are beginning to see a combination of indicators that seem to indicate for us that the market is pretty much on the way to revert back up to its mean or above the mean, which is where it is right now by trading above 1790. What I want to do here is take a look at the Fibonacci retracement from the recent high that we saw here of about 1918 that we made in July to the recent low here. And what this gives us is basically the Fibonacci retracements of this whole move that we saw from about June, the 1st of June, to the bottom of the market here, which is the seasonal lows that we made on the 29th. And we have basically target the 50% retracement, which coincides with pretty much, as you can see, the area of the daily in red, and the weekly targets have not yet been completed, which is you're looking at about 1819. So we got another $9 to go, but we are entering an area that is called distribution of supply. Now, let's see what the market does in between these levels here and see if we have strong buying coming to the market that essentially could bring this market up and break the resistance levels that we're looking at of about 1830. And by breaking that resistance level, 1830, 1840, we're going to have an acceleration all the way up to about 1920 over the next few weeks. I would recommend my friends continue to stay long, be patient. I think the adjustment in the precious metals is coming sooner than you think. And when it does, if you are not in that market, you're going to miss it. Thank you again for the opportunity to share this information with you, my friends. And I hope you have a great trading week. I hope you have a great trading day. Until next time, I'll talk to you soon. Take care.